3 numbers. That's all you need to know if a company is actually profitable or just playing accounting games. Most investors stare right past them and lose money because of it. Today, I'm going to show you exactly which numbers to read and why they matter more than stock price. Welcome back to Daily Investor. Look, you can follow hype, chase momentum, or you can read one financial statement and know the truth about a company's health. I've spent 5 decades watching investors choose the first path and regret it. The income statement is where reality lives. Today, we're going to break down the 4 numbers that actually matter, and I'll show you how to spot economic moats hiding right there in the margins. Let's start at the top. Revenue. This is the money flowing in. But here's what kills most investors: they confuse big revenue with good business. Take 2 companies. Amazon generates roughly $575 billion in annual revenue. Apple generates roughly $391 billion. So Amazon is bigger. Done. Except it's not. The question is not how much money came in. The question is how much of that money sticks around as actual profit. That margin difference is not a detail. That is the whole game. Revenue tells you the size of the business. Profit margin tells you if the business is actually great or just barely scraping by. Strip away the cost of goods sold from revenue. What's left is gross profit. This number reveals pricing power. Coca-Cola historically maintains gross margins above 60%. Think about that. For every dollar of revenue, after paying for sugar, water, carbonation, and the cost to bottle it, Coca-Cola keeps 60 cents. That is not an accident. That is the moat. That is the pricing power that explains why Buffett bought $3 billion worth in 1988 and it became worth $25 billion. Now compare to a retailer. Target operates with gross margins around 28 to 30%. Same basic business model: buy stuff, sell stuff to consumers. But Coca-Cola has a pricing power advantage that shows up immediately in the margins. That is the economic moat the income statement reveals. Why does this matter? If gross margins are expanding, that company is either raising prices successfully or cutting costs. Both are signs of strength. If gross margins are contracting while revenue grows, suppliers are taking more of the pie or competition is forcing price cuts. That is a warning sign that most investors miss until it is too late. Now subtract all the operating expenses. Salaries, research, marketing, rent, distribution. What is left is operating income. This is profit from the actual business before interest, taxes, and accounting tricks. Operating margin reveals whether management is disciplined or wasteful. It shows whether the company can convert each dollar of revenue into actual business profit. Apple in recent years maintains operating margins around 30 to 32%. That is exceptional. Microsoft operates at operating margins around 45 to 48%. Different industries, different models, but both demonstrating world-class operational discipline and competitive advantage. Now watch what happens to a business losing its edge. If you see a company where operating income is shrinking while revenue stays flat or grows slowly, you are watching pricing power erode in real time. Competition is squeezing margins. That is yellow flag number 1. Finally, net income. Revenue minus literally everything. Costs, operating expenses, interest, taxes, one-time charges. This is the profit that belongs to the shareholders. But this is where tricks happen. A company can have high operating income but pile on debt, pay high interest, and end up with thin net profit. Or they can take one-time charges that hide the real earnings power of the business. This is why Buffett says understand the business first, then read the numbers. The context matters. A company with $5 billion in revenue and $500 million in net profit is a 10% net margin business. Thin. Not impressive. A company with $5 billion in revenue and $1.5 billion in net profit is a 30% net margin business. That is an economic moat. That is the kind of business that compounds wealth over decades. Income statements do not lie. They just require discipline to read. Focus on 3 margins. First, is gross margin stable or expanding? That tells you if the company has pricing power. Second, is operating margin healthy and stable? That shows competitive advantage and management quality. Third, is net income real and growing? That is where wealth is actually being created. The companies that beat the market over 30 and 40 and 50 years are not the ones with the biggest revenue. They are the ones with the best and most durable margins. Microsoft, Apple, Coca-Cola, Berkshire Hathaway. Every single one shows this pattern written right there on the income statement. When you learn to read margins, you learn to read competitive advantage. And that is the foundation of everything. If you are serious about investing, not just gambling, but actually building wealth, income statement literacy is non-negotiable. Tomorrow, we are going to do the same analysis on the balance sheet. That is the second half of financial literacy that separates the long-term winners from the people who chase stocks. Subscribe right now so you do not miss it. And drop a comment, what company's income statement confuses you the most? I read every single comment and I will help you understand it.